suffer the most when this readjustment essentially plays out?
Yes, indeed. So weak players who are not nimble. If you're a nimble player, you anticipate some of these things, then you make changes. But in business, you cannot be a winner all the time. So you lose, but you come back, and you come back stronger if you're well managed and you have what we call poise.
You joined us now. Let's take the conversation forward on understand the dynamism of HDFC Bank and HDFC Limited merger, and how will this change life for a shareholder. Saurabh, by and large, the fine print is out. Let's understand what it means. The merger will take 12 to 15 months. So for shareholders right now, can next 12 to 15 months be this period of perhaps no return or no return and low return, because that marriage is still a distance away. Right now, it's only engagement. Shadi dur hai abhi.
I don't think we have to worry so much about the shadi. I think shadi to ho jayegi.
There is something called a runaway bride.
I think the growth numbers that HDFC Bank posted, I think it was Friday. Friday they posted their growth numbers for the quarter ending March. It was blistering growth. I think they're growing both sides of the balance sheet at around 25%. So and Bajaj Finance, by the way, posted similar growth numbers yesterday. So leaving aside the merger, which we like, which we are very happy about, just the sheer blistering pace of growth in HDFC Bank on both sides of the balance sheet means that we as shareholders will continue compounding regardless of the merger modalities. And this has been the story of HDFC Bank for the last 3 years. They pulled 3% market share away from the rest of the banking system. No other private sector bank has remotely matched them in the last 3 years at the sheer pace of growth of this really well-run bank. So if we focus on the economic recovery and HDFC Bank's growth, that itself is our next 12 months of upside solidly locked in there.
Okay, let's understand the return ratios and how they would move. The bank currently is enjoying a superior return ratio, which is greatly higher than HDFC Limited. The combined entity for the banking business per se, the return ratio comes down. Have HDFC Bank shareholders got a raw deal and HDFC Limited shareholders got a better deal?
I think it's a slightly different way of looking at it. The way we have done the maths is the ROA for HDFC Bank's ROA is already around 2%. HDFC Limited's ROA with HDFC Bank's cost of funding. So if you take HDFC Limited's loan book and put it on HDFC Bank's cost of funding, even after factoring in CRR and SLR, will still comfortably make a 2% ROA on the acquired book. So if you take the acquired book, put on it the new cost of funds, the HDFC Bank cost of funds, subtract from it CRR and SLR, you still make comfortably a 2% ROA. Secondly, once you lever up HDFC Bank post the deal leverage comes down because HDFC Limited is less geared than HDFC Bank. So if you lever up the entity to 10x debt equity, which should be very doable, you're comfortably looking with a bank with ROEs north of 20%. So if you take a 2% ROA, work with that, we are confident that both entities will have a 2% ROA even after CRR, SLR, and then lever up 10x, you're at 20% ROE. And my reckoning is with the cross-selling benefits then kicking in, you're looking at a giant bank which will make ROE north of 20%, potentially growing the loan book at north of 20%. You can't ask for more than that in a large, well-run bank.
I looked at Federal Bank numbers, a small base, and yet their growth is contracting, and HDFC Bank on a large base, they are expanding. So now the technical factor, which is that the market cap of HDFC Bank and HDFC Limited is about 14-15%. The combined entity may be a restrictive factor for a lot of mutual funds, because mutual funds are not allowed to own one single entity for more than 10% stake. So could that lead to adjustment? Let's say even in your portfolio, I'm sure there would be, irrespective of how great the story or proposition is, you may not want to take in more than 10-11% exposure to a single stock.
I think this is a very good point you make. So I'm not so sure the Indian mutual fund will be the critical driver to think if you take India over the next 10 years. I think the rise of the alternatives industry, the rise of firms like us, because we're a PMS, we don't face any SEBI imposed restrictions on position sizing. So our largest position is Asian Paints, around 12-13% of our portfolio tends to be Asian Paints. HDFC Bank was our second largest position at around 9%. We'll revisit as we get more clarity on the deal mathematics and the evolution of how the two entities come together. We'll revisit whether HDFC Bank should be a little higher part of our portfolio, a little lower, but we don't face any restrictions from the regulator on how large an allocation can be in our portfolio. And just as importantly, foreign investors don't face any restrictions either. So my reckoning is whatever is freed up by mutual funds because of the sort of position sizing limits you're referring to, Nikunj, foreign investors and alternative investors like us will happily load up on. You don't get too many opportunities like this in life. As I said, the mathematics is quite straightforward. You don't get too many opportunities like this in life to load up on a money creation machine of this scale, and I don't think too many people out there, foreign investors or domestic alternatives like us, will let go of this.
Okay, so now how does one understand the true value of HDFC Bank? Because HDFC Bank up until now was a compounding machinery, a bet on brand, India's growth, retail book, and great in terms of understanding risk. Now HDFC Bank will get a chance to increase the mortgage business. They also become the holding company for the other businesses of HDFC Bank, HDFC Group. How does one understand the true value of the franchise?
I think it was probably on your show, Nikul, that you guys had asked me 6 or 7 months ago, and I said that a decade hence, several of these giant Indian compounding machines, right, the TCS and HDFC Bank. In fact, I distinctly remember saying on your show that a decade hence these companies will be north of $1 trillion. I think that estimate now looks very conservative. Actually, a decade hence, this bank being north of $1 trillion looks to me to be a very conservative estimate now. If you step back and think about it, right, in a modern economy, the heart of the economy is the financial services system, because that's where all the money, all the capital gets allocated. Unsurprisingly, financial services is 35% of our stock market. I would say around 25% of GDP is financial services. That's the commanding heights. The commanding heights of a modern economy is financial services. And what's happening there is, if you include SBI, perhaps 5 giant financial institutions. So HDFC, the Empire, ICICI Empire, the Axis Bank construct, the Bajaj Finserv Empire, 4 of these private sector institutions, SBI if you include a 5th public sector one, these 5 institutions now occupy the commanding heights of the most powerful sector of the economy. As the economy expands over the next 10 years, this sector will be strategically important. And in this sector, in financial services, 3 things will be critical. Technology, data, how much data can you access? How cleverly can you mine the data? An empire like HDFC's will have unrivaled access to a wealth of customer data. Secondly, distribution. How deep can you hit into the interiors of the country? How strong is your online penetration? And thirdly, cost of capital. I think Vallabh Ansali Saab was also referring to it. If you have low cost of capital, you have deep distribution reach, both physical and digital, and you have data, you really are a master of the modern financial system, the modern economic system. If you see HDFC Bank like that, they are basically sitting in an incredibly powerful strategic position over the next decade or so. So I had said a few months ago on your show, $1 trillion market cap a decade hence. I honestly believe that's a very conservative estimate, given the rate at which the bank is going and given the power of the deal to transform HDFC Bank further into an even more profitable entity.
Sometimes I wonder that if you believe in 5-6 stocks which are going to be great compounding machines, and you've been very vocal about talking about them, whether it is Asian Paints, Pidilite or HDFC franchise or TCS, then the clients would say, Saurabh Mukherjea, why should we pay your fees?
No, I'm glad that they don't, all of them don't say that. They're busy people. I think they've got lots of other things to do with their life and their money, and hence
fees brings a smile on your face.
Because there's the Poshak and the GMM Fodler as well.
Fees brings a smile on his face. And a pause.
No, I think we're in a country where the economic construct evolves so fast that just to sort of keep it together, keep your wits about yourself, deal with things like Ukraine, the whole COVID drama, clients need people like us. As I said, most of them are in senior corporate roles. They're running businesses themselves. So handing over their money to people like us is their way of optimizing their time and their wealth. And I'm hopeful that that'll continue as more Indians get richer, as more Indians build successful businesses, rise in the corporate world. They'll need people like us to look after their monies, and hence we are a small part of that financial services ecosystem which companies like Bajaj and HDFC Bank dominate.
Right. Okay, by the way, HDFC Bank, after that near 10% move, is down today. And I'm just going to bring up the intraday graphs for both HDFC as well as HDFC Bank, because in sync with each other, 1.7% lower is both those stocks. Of course, yesterday's move was a little bit exaggerated for a blue chip heavyweight like HDFC Bank. Today, these stocks are petering down and definitely having its bearing on the market as well. The Nifty is lying absolutely flat, and it's banks and financials which are dragging lower. Bajaj Finance as well is a top loser on the index. Kotak Bank is also down 1.5%, and the rest of the banking pack is well underperforming. But sort of just one more question before we wind up and move on to other banks. What do you do as an investor? I mean, obviously if you've been holding HDFC Bank as a compounding story, you continue with your investment. That's like a no-brainer. But for those looking to add fresh positions, for those, millennials / Gen Z who are now wanting to buy the stock afresh, can they buy even now for a 10-year horizon?
I mean, look, I don't see why not. As I said, if you look at their own loan growth, HDFC Bank's loan growth over the last 5 years, it's north of 20%. The recent business update from HDFC Bank suggests again 25% growth. As I said, they're not alone. Bajaj Finance, the second largest NBFC, interestingly, is also growing at a rapid rate. So if you've got a view that the country's the Indian economy is in broadly healthy shape, is evolving into becoming a second world country over the next 10 years, why would one hesitate investing in India's best run lenders, one bank, HDFC Bank, one non-bank, Bajaj Finance. And I'll say with full candor that both we as a firm, Marcellus as a firm, and I as an individual have large positions in these lenders, but I also don't see why others shouldn't benefit from this. It's a relatively transparent situation, fast growing lenders. The market is not, I stress again, the market does not fully discount these sorts of high growth rates over extended periods of time. And therefore, if the market doesn't do the job properly of discounting fully the growth, the future growth, it gives you undervalued shares. And our job, and everybody who's watching, your job is to make money from buying these well-run, undervalued companies.
Okay, so the investors will make money. Now, Saurabh, just the entire landscape that you do have, right, with the financial sector lenders, Axis, which has been on an acquisition spree, you've got what's happened with HDFC, Bajaj Finance, one more strong business update. And how do you see this landscape and the traditional debate of HDFC versus ICICI?
So I think two parts of the landscape, which I find very interesting. I think what's been very interesting over the last 6 months is many of India's smartest capital allocators have put their chips on the table. So you saw Asian Paints making small acquisitions. You saw Pidilite making small acquisitions. Obviously, what Amitabh and Axis have done, the HDFC Bank deal. In small caps, we've seen people like GMM Pfaudler make acquisitions. Superajit, which I think is the smartest capital allocator in auto ancillaries, make an acquisition in Germany. So it's very interesting, right? The smartest capital allocators in India are telling us through their actions, as much as their words, through their actions, they're telling us, this is an economic recovery. I am putting money on the table. I am putting my chips on the table. I want to benefit from the recovery. And I think all of us out there should take heed of that. If smart companies, several smart companies in the 6-month period are putting money on the table, it's worth taking cognizance. And secondly, coming to lending, as I was saying, it's difficult now to see, given this arms race that is underway. It's a little bit like an arms race where powerful financial service institutions are basically competing with each other on technology, on distribution, on access to cheap capital. It's difficult to see how other lenders who haven't yet joined the game, the acquisition game, how they can afford to be left out. So my reckoning is we will see more M&A action over the next year. I don't even think it'll take a couple of years. I think in the next 12 months, you will see more action. as other lenders who don't want to be left behind also end up bulking up, focusing on distribution, on technology, and on the cost of capital side of things.
Saurabh Mukherjea, in all your books and all the stuff that you write and interviews you say, you always said one thing, right? Follow the cash. Don't follow necessarily the profits, because, and you bring out this whole analogy about how sometimes the companies you invest in, the cash compounds faster than maybe the bottom line. But if we are going to be in the season of M&As, that's going to impact the cash. So what's it going to do to your strategy?
So good point. So firstly, in banking, there is no sort of cash concept, right? You can't really do free cash flow in banking because of the whole construct around how banks fund themselves. So in banks, the number we look at is book value. Book value per share is the main metric to focus on in banks. And as I said, on that metric, the HDFC Bank, HDFC deal looks to us to be very attractive. On the acquisition side of it, what's very interesting, and I'm glad you raised this point, is what smart companies are able to do, and it's in a way that's what makes them almost magical. They're able to acquire, so that eats up their cash as they acquire, and yet within 2 years you see that the acquisition throws off lots of cash. So I will say a good case in point is if you look at Dr. Lal Path Labs, he's been steadily doing, Manchanda has been steadily doing small acquisitions over the last 6 or 7 years. But in spite of that, his free cash flow, Dr. Lal's Path Labs free cash flow has compounded at 35%. Pidilite similarly, over the last 5-6 years, they've done several acquisitions, and yet free cash flow compounding for Pidilite tends to be pushing towards 25%. So the skill of a high-class company is to expend cash on acquiring and still grow free cash flows at a 25% rate. And that in a way is the sort of the Sachin Tendulkar type company that we all aspire to invest in and compound our wealth.
Saurabh, great to have you on the show. Thanks as always for taking the time out and discussing your view on financials with us.